Preparing for a Telefonica Financial Analyst interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Walk me through Telefonica's business model and main revenue streams. Telefonica generates revenue primarily from mobile services, fixed broadband, television, equipment, and enterprise technology solutions. Its major operating markets include Spain, Germany, Brazil, and other Latin American operations, alongside its UK joint venture exposure. I would separate recurring service revenue from handset sales and other lower margin items, then assess growth by customer, product, and geography. The business is capital intensive, so revenue quality, churn, pricing, and free cash flow matter as much as headline growth. While answering, focus on Telefonica's telecommunications footprint, mobile and fixed connectivity, consumer and enterprise customers, geographic diversification, recurring revenue characteristics, and how network investment supports long-term monetization. Question 2. Which operating KPIs would you monitor when analyzing Telefonica? I would begin with service revenue growth, mobile and fixed broadband additions, ARPU, churn, and the mix between contract and prepaid customers. For fixed operations, fiber penetration and convergence are important because bundled customers usually have better retention. I would then connect those indicators to EBITDA margin, CapEx intensity, operating cash flow, and leverage. A strong report should explain not only whether subscribers increased, but whether customer economics and cash conversion improved as well. Make sure to cover service revenue growth, ARPU, churn, customer additions, broadband and fiber penetration, contract mix, EBITDA margin, CapEx intensity, and how operating KPIs translate into cash generation. Question 3. How would you build a revenue forecast for Telefonica? I would forecast revenue by country and product rather than applying one group-wide growth rate. For mobile, I would model customers, contract mix, churn, and ARPU. For fixed broadband, I would estimate homes passed, penetration, additions, and pricing. I would separately forecast equipment and enterprise revenue, then apply exchange rate assumptions to international businesses. Finally, I would compare the result with management guidance and historical seasonality, investigating any material variance before finalizing the model. In your answer, talk about segment-level drivers, subscriber volumes, ARPU, retention, product mix, pricing actions, foreign exchange, seasonality, and reconciliation between operational assumptions and reported revenue. Question 4. What is ARPU, and why is it important for Telefonica? ARPU means average revenue per user, usually calculated as service revenue divided by the average active customer base over a period. At Telefonica, it helps distinguish growth driven by valuable customers from growth driven purely by volume. ARPU can rise through price increases, premium plans, cross-selling, or a richer customer mix, but aggressive pricing may increase churn. I would therefore review ARPU with customer additions, retention, and margins rather than treating it as a standalone success metric. Be sure to mention average revenue per user, its calculation, prepaid and contract differences, pricing versus mix effects, promotional pressure, and why ARPU should be analyzed alongside churn and customer acquisition costs. Question 5. How would you analyze Telefonica's churn and customer growth? I would distinguish gross additions from net additions, because strong sales can conceal elevated customer losses. I would also separate prepaid and contract churn, since contract customers generally provide greater visibility and value. The analysis should examine promotional discounts, network quality, pricing, handset financing, and bundled products as possible drivers. If churn rises after a price increase, I would test whether the resulting ARPU benefit outweighs lost customers, lower lifetime value, and additional acquisition costs. Focus on voluntary and involuntary churn, prepaid versus contract customers, gross additions, net additions, retention economics, promotional intensity, network quality, and the impact on lifetime value and revenue forecasting. Question 6. Explain the difference between EBITDA, EBIT, and free cash flow in a telecom company. EBITDA measures operating profit before depreciation and amortization, so it highlights underlying operating performance but ignores the cost of using networks and acquired assets. EBIT deducts depreciation and amortization, providing a closer view of asset consumption. Free cash flow goes further by reflecting taxes, working capital, interest, capital expenditure, and often lease payments. For Telefonica, EBITDA is useful for comparison, but free cash flow determines capacity to fund dividends, reduce debt, and invest in spectrum and fiber. In your answer, define each measure, distinguish operating profitability from depreciation and capital spending, discuss lease effects, and explain why free cash flow is crucial for dividends, debt reduction, and spectrum investment. Question 7. How would you assess Telefonica's capital expenditure requirements? I would split CapEx into maintenance, capacity, spectrum, fiber, and 5G-related investment. Maintenance protects current service quality, while growth CapEx should create additional customers, higher ARPU, lower operating costs, or strategic optionality. I would track CapEx as a percentage of revenue and compare it with network coverage, traffic growth, fiber penetration, and competitor spending. The key question is whether investment earns an acceptable return without weakening free cash flow or pushing leverage beyond management's comfort. Make sure to discuss fiber rollout, 5G, spectrum, maintenance versus growth CapEx, CapEx intensity, network sharing, expected returns, and the tension between service quality, competitive positioning, and free cash flow. Question 8. How do International Financial Reporting Standards 16 leases affect Telefonica's financial statements? International Financial Reporting Standards 16 generally brings operating leases onto the balance sheet as right-of-use assets and lease liabilities. Instead of recording the full rental expense and operating costs, the company records depreciation and interest, which usually increases reported EBITDA while adding liabilities. Cash payments still matter economically, even if their classification changes in the cash flow statement. When analyzing Telefonica, I would use consistently defined leverage and free cash flow measures and avoid comparing International Financial Reporting Standards 16 treatment inconsistently across peers. While answering, cover right-of-use assets, lease liabilities, depreciation, interest expense, EBITDA presentation, cash flow classification, leverage metrics, and the importance of comparing companies consistently. Question 9. What factors would you consider when evaluating Telefonica's leverage? I would calculate net debt relative to EBITDA, but first clarify whether lease liabilities, hybrid instruments, and joint venture debt are included. I would examine debt maturities, fixed versus floating rates, currency exposure, average interest cost, liquidity, and free cash flow coverage. A leverage ratio alone is insufficient if EBITDA is temporarily inflated or cash generation is weak. I would also assess whether Telefonica's deleveraging plan relies on recurring operating cash flow, disposals, refinancing, or favorable exchange rate movements. Be sure to mention net debt, EBITDA, lease liabilities, maturities, interest costs, cash flow, currencies, pension or spectrum obligations, ratings, and whether deleveraging depends on asset disposals or recurring operations. Question 10. How would foreign exchange movements affect Telefonica's results? Foreign exchange affects Telefonica through translation of international revenue, EBITDA, assets, and cash flows into euros, as well as through transaction exposure on costs, debt, and equipment purchases. I would present both reported and constant currency growth to separate operational performance from currency movements. I would also review hedging and debt denomination, because a weaker local currency can reduce reported earnings while creating benefits or risks on local liabilities. The conclusion should distinguish accounting volatility from economic cash flow exposure. Focus on translation and transaction exposure, Latin American currencies, reported versus constant currency growth, EBITDA and cash flow effects, debt denomination, hedging, and the distinction between accounting volatility and underlying operating performance. Question 11. How would you value Telefonica using an EV/EBITDA multiple? I would select telecom peers with comparable geography, customer mix, growth, margins, leverage, and accounting treatment. After calculating enterprise value to forward EBITDA, I would apply an appropriate range to Telefónica's normalized EBITDA. I would ensure lease liabilities are treated consistently across peers, then bridge enterprise value to equity value by subtracting net debt, leases if included, pensions, and other claims, while adding non-operating assets. I would test the valuation against growth, cash conversion, and balance sheet risk. In your answer, explain enterprise value, comparable company selection, LTM versus forward EBITDA, lease treatment, growth and leverage adjustments, and the bridge from enterprise value to equity value. Question 12. How would you build a DCF valuation for Telefónica? For a DCF, I would forecast revenue by market and product, EBITDA margins, taxes, working capital, CapEx, and depreciation, then derive unlevered free cash flow. I would discount those cash flows using a WACC reflecting Telefónica's operating risk, country exposure, capital structure, and interest rates. Terminal value requires conservative growth assumptions because telecom markets mature. I would present sensitivities for WACC, terminal growth, margins, and CapEx, then reconcile enterprise value to equity value. Make sure to cover revenue and margin forecasts, CapEx, working capital, taxes, free cash flow, WACC, terminal growth, net debt, scenario analysis, and sensitivity to telecom-specific investment cycles. Question 13. What are the key risks facing Telefónica's dividend policy? I would assess whether dividends are covered by recurring free cash flow after maintenance and strategic CapEx, rather than by accounting earnings alone. Key risks include higher interest costs, weak currencies, regulatory pricing pressure, spectrum payments, fiber investment, and refinancing requirements. I would also examine leverage targets and whether distributions depend on asset sales. A dividend can be affordable in 1 year but unsustainable over a cycle if cash conversion deteriorates or investment demands increase. Discuss free cash flow coverage, leverage, spectrum and fiber spending, refinancing needs, regulatory changes, earnings volatility, asset disposals, shareholder expectations, and why declared dividends may differ from sustainable distributions. Question 14. How would you analyze a Telefónica acquisition or strategic partnership? I would start with the strategic rationale, customer expansion, network efficiency, spectrum access, scale, or technology capability. Then I would quantify revenue and cost synergies, implementation costs, timing, financing, and regulatory constraints. The valuation should include standalone value, control premium, and sensitivity to slower synergy realization. I would test pro forma leverage, earnings accretion, and free cash flow returns, asking whether the transaction creates value after integration risk rather than simply increasing scale. Focus on strategic rationale, customer and network synergies, purchase price, financing, regulatory approval, integration costs, accretion or dilution, return on invested capital, and downside scenarios. Question 15. What is the significance of Telefónica's joint venture exposure in the UK? A joint venture can provide strategic scale and synergies without appearing fully in consolidated revenue or EBITDA, depending on the accounting treatment. I would understand Telefónica's share of earnings, cash distributions, capital commitments, debt, and value creation separately from reported group metrics. I would also evaluate network synergies, competitive dynamics, and regulatory constraints. For valuation, I would avoid double counting by valuing the joint venture appropriately and reconciling its contribution to group cash flow and net asset value. Be sure to mention proportionate versus reported economics, equity accounting, dividends, synergies, network scale, regulatory considerations, valuation transparency, and how the joint venture affects group-level analysis. Question 16. How would you assess the impact of a major price increase on Telefónica? I would model the price increase using several elasticity scenarios rather than assuming full pass-through. The calculation should estimate ARPU uplift, affected customers, timing, incremental revenue, churn, retention costs, and competitor reactions. I would also distinguish contract customers from prepaid users and consider regulatory or contractual restrictions. A successful increase improves revenue and margin while retaining customers. An unsuccessful one creates temporary ARPU growth but damages volumes, lifetime value, and brand positioning. In your answer, cover customer elasticity, ARPU uplift, churn, timing, contract terms, competitive response, regulatory limitations, revenue impact, margin effects, and the distinction between short-term and long-term outcomes. Question 17. Tell me about a time you found an error in a financial model. In a forecasting model, I noticed EBITDA margins moved sharply despite stable operating assumptions. I traced the issue to a formula that omitted a regional cost line after a column was inserted. I compared outputs with the general ledger in prior periods, corrected the formula, and documented the change. I then added balance checks, variance flags, and a peer review step. The experience reinforced that strong modeling combines technical accuracy with disciplined validation and clear communication. Focus on the analytical process, validation checks, root cause diagnosis, communication, correction, documentation, and prevention controls, while demonstrating ownership rather than blaming another team member. Question 18. How would you explain a variance between Telefónica's reported EBITDA and your forecast? I would build a bridge from forecast to actual EBITDA, separating volume, pricing, mix, personnel costs, energy, foreign exchange, one-offs, and consolidation changes. I would check whether the variance reflects timing or a permanent change in the business. I would then compare management commentary with the reported segment data and update the model only after identifying the underlying driver. A good explanation quantifies each factor and states whether the variance changes the forward outlook or merely the current period. Make sure to distinguish operational, accounting, timing, foreign exchange, one-off, and consolidation effects, quantify each driver, compare against guidance, and update assumptions transparently. Question 19. How do interest rates influence Telefónica's valuation and financial performance? Higher interest rates can raise Telefónica's refinancing cost, reduce free cash flow, and pressure customers' ability to pay for premium services. They also increase the discount rate used in valuation, lowering the present value of long-dated cash flows. I would review fixed and floating debt, maturity schedules, hedging, and bond market access. Higher rates can also reduce asset values and make dividends less attractive relative to bonds, so both earnings and valuation multiples may contract. Discuss refinancing cost, floating rate debt, discount rates, bond values, pension effects, consumer affordability, capex returns, and the interaction between higher rates, leverage, dividends, and equity valuation. Question 20. Why do you want to work as a financial analyst at Telefónica? I am interested in Telefónica because telecommunications combines recurring customer revenue with complex investment decisions in fiber, 5G, spectrum, and digital services. The international footprint would let me analyze operating performance alongside currency and regulatory factors. In a financial analyst role, I would contribute through disciplined forecasting, KPI analysis, variance explanations, and clear communication to decision-makers. I also like that the sector requires balancing near-term cash generation with infrastructure investment that supports long-term competitiveness. In your answer, connect genuine interest in telecommunications, recurring revenue analysis, capital-intensive infrastructure, international operations, analytical responsibilities, communication skills, and how you would contribute to evidence-based decisions. If you are still with us, congratulations. You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.